You're going to have demand through the roof for commodities,
And
and not
limited
the
supply.
and not yeah, limited supply, and so the only thing it can give is price. So for a period of 2 or 3 or 4 years, you're going to have prices going straight up. I think I gave you a number on oil. Natural gas will go through the roof. I think all base metals will go through the roof, and gold I think can get to 20,000. Silver can get to 500. It'll be a it won't be there long. It might last a few years, but it'll create a problem because not only do we have 320 trillion in debt now, we are probably going to go to 500 trillion in the bust or soon after the bust.
David Hunter, a contrarian macro strategist with decades of experience in the financial markets, has what many will call shocking predictions for the global economy and the resource sector. Beginning from mid to late 2025 to the turn of the decade, Hunter is predicting a global deflationary bust, which he says will have the intensity and duration of a recession, depression, and a stagflation, all rolled into a considerably prolonged period of gloomy economic conditions for the United States and other major economies. Hunter believes this bust will be caused by widespread banking collapses, as the decades of its terrible and extortive business model finally catches up with the global banking industry. As with previous crises, Hunter says the Federal Reserve and other central banks will try to prevent a complete system collapse by printing money to rescue the ailing banks. However, as a result of the massive leverage in the system, they will realize they need to print more and more to even make the tiniest dent. As the COVID money printing easily dwarfed previous money printing exercises, Hunter says this next round of money printing will be unlike anything we've ever seen. He is predicting that the Federal Reserve alone will print as much as $20 trillion to try to get us through the bust. This excessive money printing will have investors rushing to exit the system. The only problem is that the world has managed to underinvest in the resource sector for decades, which means there will be very limited supply to meet the demand. This is why Hunter has very bullish predictions for commodities such as oil, copper, gold, and silver. As the global economy recovers from the bust after the unprecedented money printing, Hunter predicts gold prices will climb to $20,000 and silver to $500 per ounce. We will now present clips from David Hunter's recent interview with Goldcore TV. But before we do, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. Thanks for the support, and we hope you enjoy the video. At the beginning of the conversation, Hunter talks about the current state of the market, describing what he terms a temporary market melt-up that started earlier this year and will become even more pronounced when the Fed starts cutting rates in September.
That's healthy. I mean, what we have here is a lot of fear in the market. They're caught in the middle because every time it starts going up, they want to sell, but they go, I've got burned. I got to stay on board. But there's a lot of money on the sideline. There's a lot of defensiveness in institutional portfolios. And I think that's the fuel that's going to allow this thing to go higher. What it needed was the Fed. And then the Fed's dragged its feet, doesn't want to cut. But it's pretty much now pretty obvious. The Fed's going to cut at their September meeting. The only question is, are they going to cut a quarter or a half? I think that's what we're waiting for here. What you're seeing in the economy is signs that the economy is slowing, no question about it. The consumer is starting to run out of gas, no question. He's still spending, but he's having to take more out of savings, and the savings is being depleted. They're spending. You look at the monthly numbers, and they're spending more than the income coming in. So credit debt is going up. You're seeing delinquencies go up. So a lot of signs that we're getting to the end of this cycle. But then we get news after they got all worried about recessions here, and we got a surprisingly good consumer number, consumer spending number. We've had good inflation numbers. The service sector today's service sector ISM was 55, so that looks like it's still fine. Manufacturing's below 50, so that manufacturing is in recession probably, or at least slowing. But the point is, I think we have enough information out there to say we're in a soft landing. It's going to be a narrative, I think, from here into the election where it's going to be soft landing, Fed's on board, easing, and inflation's falling or inflation's continuing to slow. And I think that's the narrative that drives us. The reason I went through all that about the skepticism is that there's plenty of pent up demand. And I think you're going to see finally, as this thing comes out of this pullback and goes to new highs, you're going to have people finally getting on board because with the Fed easing, I think what you're going to get from the institutions is a view that we now can look out to 25 and 26 and say the economy is going to pick up speed. Inflation is still going to be under control. And that's very bullish. So it's kind of a Goldilocks scenario that I think you get. It won't last long. That's what they believe. They can start building in higher earnings for 25, which is what now is going to drive the market. It's not this year's earnings anymore. It's next year they're looking at. I think you're going to have growing earnings, lower interest rates, and lower inflation. And I think because so many people are in the same boat, skeptical, you're going to have short covering, you're going to have people having to get on board, people moving from defensive to more aggressive. And the momentum of the market's the narrative is not going to be slightly better. I think you're going to see somewhat, a ramping up of earnings, a ramping up of expectations for 25. And again, that's not my view. My forecast for 25 is quite dire, but I think for a period of time between now and the election, I think the narrative is going to be better earnings, maybe even significantly better earnings, and inflation under control, significantly lower interest rates. I think the 10-year can get down to 2.5% this year.
Wow.
So if you get a 2.5% 10-year and the Fed cutting rates, so short rates coming down, all of a sudden you've got wind at your back.
According to David, the Fed and other central banks printing massively to get us out of the bust will not just cause a commodity supercycle of epic proportions, it will also lead to a sharp spike in inflation. David is predicting that inflation will spike as high as 25% later this decade and early into the 2030s. The renowned analyst is also predicting double digits unemployment in the US and worse in other countries, alongside a financial crisis that will result in more bank failures, real estate crisis, and a steep recession. In his words, this could be something we haven't seen since World War II, in terms of a severe economic and financial system breakdown. The response to this will likely be massive money printing, despite current assurances from the Federal Reserve that they won't return to quantitative easing, QE. When faced with a free-falling financial system, David is certain that central banks will be forced to collectively turn on the printers and pump tens of trillions of dollars into the system. This influx of money will eventually flow into assets, leading to a commodity cycle, beginning around 2026 and continuing through the rest of the decade. Let's get back to the interview.
That money that will be printed they'll be coming up with every program they can, just like they did in 2020, to help the consumer, to bail out pension funds, to keep the money markets, fuck, etc. And that money will find its way into assets. We will see a commodity cycle following the bust. So beginning in 26, probably later 26, and all the way through the balance of the decade, you could take oil to $500. I think oil next year can get to $30, but by the end of the decade could be at 500. Copper could get down. I'm calling for copper this year at 6. Could get down to $1 and somewhere near $1 in the bust, and then by the end of the decade could be 20 or 30. So the problem is what you're going to do is you're going to, with that, and I say 20 trillion, it's just a seat of the pants guess, but with that 20 trillion, it's gonna goose demand. You're gonna get this huge demand in a couple of years out, and we're gonna be reindustrializing. We're reshoring, we're bringing the industry back from China, et cetera. So the consumer is going to be digging out from a an 80% bear market and double-digit unemployment, they're not going to be in any big hurry to spend, or they're not going to have the wherewithal to spend. So it's not going to be a consumer-driven economy like we've seen for the last 30 or 40 years. It's going to be back to the 70s and early 80s where it's industrial, big capacity buildup. Semiconductors, we're already seeing it, obviously. We're seeing it in steel. We'll bring steel back here, et cetera. And I think the world's going to be resourcing things, reindustrializing. And what we've done is over the last, let's say the last 30 years or more, we've rationalized down our infrastructure. So, our capacity for producing commodities. So if you goose demand and it comes back quickly because of all that money, it takes a good 7-8 years to build demand to match that, right? So you're going to have demand through the roof for commodities
and limited supply,
limited supply. And so the only thing it can give is price. So for a period of 2 or 3 or 4 years, you're going to have prices going straight up. I think I gave you a number on oil. Natural gas will go through the roof. I think all base metals will go through the roof. And gold, I think, can get to 20,000. Silver can get to 500. It'll be it won't be there long. It might last a few years, but it'll create a problem because not only do we have 320 trillion in debt now, we are probably going to go to 500 trillion in the bust or soon after the bust. So we'll have 500 trillion in global debt, and interest rates will match and will be following inflation up. So in this country, we'll be looking at 15 to 20% interest rates or higher with debt that we can't service now at 5%. It leads to something very dire, a depression, far beyond what we saw in the 1930s. Out, let's say, in 2033, 4, 5, somewhere out there. I think this year, and it can spill into the first part of next year, I have a target on my gold of 3,000. I'm likely to raise that by several $100s. I think it's conservative at this point, given that gold's at 2,500. My silver call is $75. It had been 60, and I raised that in my last letter. So I think silver can go to 75, let's say between now and the end of the first quarter.
After an 80% bear market decline in the stock market, Hunter is predicting that equities will only continue to consolidate for years without making any new highs. For the macro strategist, the wise and safe play for investors is commodities which he believes will have what will be similar to the equities bull cycle of the past 40 years. He is also predicting the eventual collapse of the fiat Ponzi in the 2030s, another event that would make a strong bull case for hard assets and real stores of value like gold and silver. What are your thoughts on David Hunter's predictions for gold, silver, and other precious metals? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.